Are you interested in how to shop for a mortgage? Well, I'm going to give you 7 steps on how to follow that process. And I'm going to do it right now. Hi everybody, my name's Ty Eden. I'm with Exit Realty Redefined in Wheaton, Illinois. And I am a realtor for a little over 2 years. I work with buyers, sellers, and investors throughout the DuPage County and Northern Illinois, Chicagoland area. So I'm bringing to you a video for you first-time home buyers that are looking to figure out how do you shop for a mortgage. Do you want to know how not to be in debt with a mortgage? Well, I'm going to give you some points right now. Now, if buying a home is going to be the largest purchase that you make in your lifetime, the mortgage that you secure is probably going to be the largest debt that you're ever going to have in your lifetime as well. A mortgage is a long-term financial obligation, and the mortgage rate that you pay substantially affects the overall cost of that mortgage. Just a 0.5% interest difference could affect your overall payment by tens of thousands of dollars over the life of the loan. Now, here's some steps that you need to follow. Number 1, get your credit score. Now, lenders will generally run your credit in order to get a credit score because that determines if you qualify and what type of loan you qualify for. Generally, the higher your credit score is, the better terms you have, the lower the interest rate, the less money that you pay. The best plan of attack is before you start actually going out and shopping for a house, go out and get your credit score, your credit report run. There's some free services online that you can go to, Credit Karma, places like that, where you don't have to pay anything, but you can get your credit report. And give yourself 6 months, because you may be surprised. There might be some errors on the report. There might be some derogatories that you need to get a chance to clean up. So that way, by the time you are ready to actually go out and start shopping for the mortgage first and then the house, you want to make sure that you can get your credit score to as high of a number as you possibly can. I think 850 or 900 is the highest score that's out there today. Now, the biggest emphasis that I can make to you is you don't want to talk to just one lender. You don't want to call one lender or bring up one lender on the computer and just settle on that lender as being the lender of choice, because you have no idea what options there are out there. So make a phone call, make several phone calls, shop the lenders and see what the differences are amongst them. Now, each one is going to want to run your credit report. And it's pretty common. Most people understand and know that each time someone runs your credit, that can drive your credit score down. Now, if you know enough, which most first-time home buyers don't know, you want to figure out what type of a loan that you need. There are a lot of different types of loans out there, and most of them are really dependent on what your credit score is, how long you plan on living in the home, how much you can afford to pay, and how long you want that loan to be out there for. Also, how much of a down payment can you put against the loan as well. Now, a conventional mortgage loan represents about 65% of the loans that are out in the marketplace today. A conventional loan is generally a 30-year fixed rate, which means that the interest rate doesn't change for the entire 30 years that you are borrowing the money for. They generally are going to require that you put down somewhere between 15 and 20%. If you put 20% down, then you won't have to have private mortgage insurance, and that's another topic for another time, another video. The conventional loans are typically done by private institutions, banks, some local area banks, credit union, something you never hear of, a thrift institution, mortgage companies that's all they do is they make mortgage loans. And did I say credit unions? Credit unions as well. And depending on the size of one of those institutions, those loans may be guaranteed or backed by either Fannie Mae or Freddie Mac. Those are the two government institutions that actually insure those loans for those smaller institutions. Then there are government-backed loans. These loans are also made by the same lenders as your conventional loans, but they're backed by the federal government. These loans are a little bit easier to qualify for because you can have a little bit less of a credit score. You can have a little bit less of a credit score if you have a little bit less money that you can put down on the loan as far as a down payment. And the payment terms are a lot more flexible than your conventional loans. These loans are aimed towards your first-time home buyers, low-income buyers, but anyone can apply for these. Typically, you hear these loans being an FHA or Federal Housing Authority type backed loans. The other thing you want to be aware of is what's the nature of the loan? Is it a fixed rate? Is it a set rate type loan, a variable rate? As I said just a couple minutes ago, a fixed rate loan means that the interest rate is going to remain the same throughout the life of the loan. Now, you can get loans for 10 years, 15 years, 20 years, 25 years, 30 years, 45 years. You can go, there's just a number of years that you can get these loans for, but the interest rate stays the same throughout the life of the loan as long as you are paying against that loan. Doesn't mean you can't pay it off sooner. If you have extra money in your pocket that you want to throw at the loan, you can do so. It'll save yourself that extra interest, even though the interest is deductible off of your income taxes, at least for now. Then you have an adjustable rate mortgage, which is referred to as an ARM, A-R-M, adjustable rate mortgage. Now, sometimes these loans will have a lower, smaller type of a teaser rate to get you into the loan, make it affordable, and then after some sort of pre-designated time period, that interest rate starts to creep up, either gradually, or radically. As that interest rate rises, so does the amount of your payment towards that loan. So these loans are really only beneficial to those folks who know that they're not going to be in a home for a very long period of time. Maybe they feel like they're going to get out of the home before that interest rate changes. So sometimes these loans won't start making their changes until 3 years, 5 years, 7 years, something of that nature. But they continue to escalate after that initial time period has gone by. Now, the next point is you want to contact several lenders, as I had said earlier. Pick up the phone, make some phone calls, reach out, see what different types of lenders there are out there. Now, there are individuals that are loan brokers. Now, these loan brokers can work either directly for you, but you pay them a fee, and or they work for a lender or a number of lenders, and those lenders will pay them that fee. That's how they make their money. Some of these loan brokers will actually compile an application package, go through some initial review, and then submit that application to a lender or a number of lenders. Unless that mortgage broker is working for you, you must have them under contract. That means that they're going to have more of an interest of finding a better deal for you, a better rate, better term, better conditions, fee considerations, everything. If you don't have them under contract, then they're basically under contract with whatever lender that they're taking your loan application to, which means they're not really shopping in your best interest. So you might want to flush that out as a part of the process of when you're going out and shopping for these mortgage brokers. Or you can apply directly to a mortgage lender, a bank, commercial bank, a credit union, institutions like that. You can go direct and deal with the loan officer that's actually employed by the lender as a comparison to the loan broker. Now, another point you want to be sensitive to is any kind of additional costs associated with the loan. Additional costs can be an application fee, a paper processing fee. There's just a myriad of different fees that can be associated with the loan application. Some of them are upfront when you submit the application. Some of them might be as you close on the transaction, and some of them can even be after you've already secured the loan and you're paying the loan off, such as an early termination fee. So it's best to serve you to smoke out all of those different potential fees that there might be associated with that particular lender when you're sitting and considering them as your possible mortgage lender. Something you don't hear too much about anymore, but was pretty popular 10, 15 years ago, are points associated with the interest rate. So a lender might offer you pay a point of the loan amount, and that can reduce your interest rate by 0.25% or 0.5%. Where this ends up being a benefit to you is if you are going to be staying within that home for any longer than 10 years, you might want to consider paying those points. A little bit of an expensive upfront cost, but over the life of the loan, it ends up saving you a little bit more money than just not paying any points and just paying the actual interest rate through the life of the loan, if you're going to stay there for the life of the loan. A loan estimate. In that loan estimate, it's going to break down all the criteria for that loan with that institution. It's almost like a a guarantee, but not really a guarantee. It's nice to get this document from a variety of these lenders, so that way you can line them up, one right next to the other, and try and determine for yourself which one of the lenders is going to be the best deal for you. Because ABC lender might be great for you, but not great for the next person that's actually applied with them. So talk to several lenders and get the loan estimate from them. It'll break down all the criteria of the loan, the terms, the costs, the fees, and then that's the actual document that you want to be making your decision from, not what you hear them say as a teaser or what you see advertised on the internet or published in some sort of publication, because you may not qualify for that deal that's gotten you in the door. The whole idea is to get you in the door and have their salesman try and pitch you on a loan product with them. When you've got that loan estimate, that might give you an opportunity to actually do some negotiating with them. See where they might be able to waive some fees, lower an interest rate, do something to make the deal a little bit better. And don't be afraid to let that lender know that you're talking to 2, 3, 4 other lenders as well as them. That'll make them more aggressive to want to actually earn your business. And to earn your business means to make it a better deal. Because what else can they do? It's a loan, it's money. Now, for more of these informative videos, hit the subscribe button down in the lower corner, and we come out with videos every week, different information for buyers, sellers, and investors, and we'd love to be able to help you in any way that we can with any of the information that we provide on these videos. Also, my contact information is in the notes, so just scroll down and you'll see the notes. I'd be happy to help or answer any questions that you may have. Thank you very much.